Okay, next topic is transfer pricing. It is a topic misunderstood by many people. The reason is that it doesn't have exact answer. It is a topic that is very subjective topic. So different scenarios will have different answers. And the exam questions as well, they will not have exact answer. They would require judgment, and based on your knowledge of this topic, whatever comment you give, if it is feasible, you would receive marks. So transfer pricing is when two companies in a group make sales to each other, or two departments or divisions in a company make sales to each other. So in a 5 level, it would usually be divisions. It would not be between two companies. That is something you would study in professional papers. But coming to division-wise, whenever one division makes sales to another division, they need to decide a price. Because if there isn't any price decided and the sales are made for free, then performance of the selling division would be understated. And also there will be no motivation for the buying division to reduce costs because they are receiving the component for free, which would ultimately mean that the profit of overall the whole company is reduced. So transfer pricing believes that there should be price at which these sales should be made. And when we have divisionalization, which means we give authority to divisions, they can decide. So that means they should also have the authority of deciding prices when they make sales to each other. And they should be left to decide it themselves. If each of them try to increase the profit of their own department, ultimately profit of the whole organization will increase, because when both of the departments are put together, the ultimate profit will increase. There are rare situations where because of the transfer price decided, profit of the whole company reduces. In that situation, we would usually intervene. Otherwise, each division has its own authority, and if we want to ask about that authority, we give them. If we give them, we have to give them responsibility. If we don't give them authority, if we don't give them responsibility, then we can't ask for it as well. If we decide a price and then their profit is not improved, then they would say that we didn't have any authority. So it is a good thing that they have authority. So transfer price, the price that is decided depends on situations. There are different situations where different prices would be appropriate. But remember two things that will help you in many scenarios. One is the minimum price. Another, maximum price. Minimum price is from perspective of selling division. So selling division wouldn't want to sell it lower than this price. And it is variable cost or incremental cost. Now, minimum price doesn't mean it is fair, but lower than minimum price would absolutely mean it is unfair. We don't use minimum price and decide that price. Minimum price gives us the lower limit, the base limit for the price. So when selling division is selling something to the buying division, it should at least cover its variable cost. If it doesn't cover its variable cost, obviously, then the profit would be hugely understated. And then we have maximum price. This is from perspective of buying division. Buying division wouldn't buy from the selling division at higher than this price. And this is usually the external market price. Now, maximum price also doesn't mean it is a fair price or it is a price that will increase profit, but it gives us that higher limit of the transfer price. So transfer price would be between these two. So if a transfer price can be agreed between the minimum price and maximum price, let's say minimum price is $15, the selling division would not sell it at lower than 15, the buying division would not buy it at higher than 20, then any price that is agreed between 15 to 20 would be something that can be agreed. When there is a situation where there is a external market, that minimum price of the selling division would equal to the external market. But when we usually say what is the minimum price that should be charged, it is usually the variable cost. But when external market exists, it would be the sales price in the external market minus cost saving on internal sales. Like the sales and distribution cost when it is sold internally will be saved. Let's say it can be sold outside for $19, and when it is sold outside there is $1 sales and distribution cost incurred. So then the minimum price that the transferring division would want is 18. But let's make it a little bit higher. Let's make this 24. They can sell it outside 24, and they have cost of 22. So this would be the minimum price. Now in this situation, transfer price would not be agreed because the minimum is higher than the maximum. So when we have external market available, usually it would be a good thing for the selling division to sell outside, for the buying division to buy from outside if they can buy at cheaper price. But remember, it will increase the profit of the whole organization. But if there was no external demand for the product that selling division is selling, or it has a spare capacity, then deciding a 22 price, obviously, because the buying division is not buying, it is buying at $20 from the outside, what will happen is the profit of the overall company will reduce, because if the selling division made it at $15 and it was sold to the buying division maybe at 17 or 18, the buying division wouldn't have to buy it from outside at $20 at higher price. So in that situation, selling price should be between variable cost and the external market price. So when external market exists for the selling division price, if they can sell it expensive, they should sell it expensive. If the buying division can buy it cheaper, they should buy it cheaper. Profit will be increased. If there is no external market available, and then this buying division buys from the outside, so it mostly will be that they buy from the outside at a higher price. It would be a good decision that the selling division sells it to the buying division at a little bit higher than the variable cost. It will increase the overall profit. Okay, so these remember this minimum and maximum, and it helps you in many decisions. Now, if only variable cost is charged, is it fair? Obviously, it is not fair for the selling division, but as I said, minimum price is not the price that is actually agreed. There will be a price that is agreed in the middle of it as well. So another thing we could do is we could charge full cost. Full cost will make sure that at least the fixed cost is covered as well. But that also doesn't necessarily mean that the full cost will be covered, because it depends on how many units are sold. Because if we are charging a price, if we are charging full cost, which would mean we would take the total fixed cost divided by total number of units that we budgeted to sell. If units are sold lower than that, it means that the fixed costs are not covered as well. There is another solution for that as well. What the selling division does is it charges variable cost, and then at the end of the year, it takes its fixed cost and it charges it on the buying division, because it basically worked for the buying division. Okay, so these are recommendation or explanation you can give. As I explained in the beginning, transfer pricing is a topic that requires a lot of judgment, and normally there isn't an exact answer. They usually ask you for recommendation. They ask you what could be a reasonable price, so you can explain these things. Okay, now let's look at a question on it. Okay, we have a question here on transfer pricing. Requirement is, under the current transfer price, prepare a profit statement showing the profit for each division and for the portable garage co PGC as a whole. Your sales and cost figures should be split into external sales and internal division transfers where appropriate. Assuming, so here we are not doing any recommendation, we are just calculating the result of what they are currently doing. Assuming that the new group purchasing policy will ensure the optimization of group profits, calculate and discuss the number of adapters which division B should buy from division A and the number of adapters which division A should sell to the external markets. There are 3 marks available for calculation and 3 marks for discussion. Assume now that no external suppliers exist for adapters which division B uses. So different scenarios given. Calculate and discuss what the minimum transfer price per unit would be for any additional adapter supplied above the current level by Division A to Division B, so that Division B can meet its maximum annual demand for the new portable batteries. There are 2 marks available for calculation, 3 marks for discussion. See, it is mostly subjective topic, so they ask you for a recommendation. Okay, Portable Garage Co. PGC is a company specializing in the manufacture and sale of range of products for motorists. It is split into 2 divisions, the battery division, Division B, and the adapter division, Division A. Division B sells one product, portable battery charger for motorists, which can be attached to a car's own battery and used to start up the engine when the car's own battery fails. Division A sells adapters which are used by customers to charge mobile devices and laptops by attaching them to the car's internal power source. Recently, Division B has upgraded its portable battery so it can also be used to rapidly charge mobile devices and laptops. The mobile devices or laptops must be attached to the battery using a special adapter which is supplied to the customer with the battery. Division B currently buys the adapter from Division A. So B is the buying division, A is the selling division. The current system is B is buying from A, which also sells them externally to other companies. So if it is selling to external, so then minimum price, there could be 2 minimum prices. One minimum price would be the sales price it is charging to the external market, which would be a sales price minus the cost that it is saving. That would be for the sales that it is making externally. If there is spare capacity, for that spare capacity, the minimum transfer price would be the variable cost that it is incurring. If there is no minimum, if there is no spare capacity, then the minimum price would be the sales price to the external market minus the cost saving. The following data is available for both divisions. Selling price for each portable battery, including adapter, 180. Cost per battery. Adapters from Division A, so it is buying adapter from Division A at $13. Other material from external suppliers, $45. And then labor cost is $35. Annual fixed overheads are $5 million. Annual production and sales of portable battery units is $150,000. And maximum annual market demand for portable batteries is 180,000 units. So it means its capacity is less than the sales that it is making, but the capacity of buying division doesn't matter. What matters is capacity of the selling division. Selling price per adapter to Division B is 13. Selling price per adapter to external customers is 15. So there is a discrimination in price. The selling division is selling at $2 lower to the internal division. Cost per adapter is 3 and labor cost is 4. So it means variable cost is only $7 and annual fixed overheads is $2.2 million. Current annual production capacity and sales of adapters, both internal and external, is 350. Maximum annual external demand for adapters is 200,000. You can see there is a spare capacity. So the spare capacity in itself is a hint. When this is both internal and external units, maximum capacity. And the external sales is 200, it means there is 150,000 spare capacity. So for that 150,000, there will be a separate minimum price, and for the 200,000, there will be a separate minimum price. The external sales is 15, and they didn't say anything about cost saving being made by internal transfer. So I would assume this 15 should be the minimum transfer price for the 200,000, and for the remaining 150,000, the minimum transfer price would be $7. And if you see the spare capacity is 150, and annual production here is 150, which is exactly that 150,000 spare capacity. So that means $7 would be a reasonable minimum price. Now, I'm not saying $7 is the price that should be charged. This is what you have to explain. This is what it's all about. Remember, transfer pricing is subjective. It requires your comment rather than just calculation. Okay, in addition to the materials and labor costs above, Division A incurs variable costs of $1 per adapter for all adapters it sells externally. Okay, there is internal saving being made. In addition to that the $3 and $4, it is making $1 cost. So that means even if there was maximum no capacity, the minimum price would have been 15 minus $1, this one saved, which would be 14. Currently, head office purchasing policy only allows Division B to purchase the adapters from Division A, but Division A has refused to sell Division B any more than the current level of adapters it applies to it. Okay, the manager of so it is currently selling at 150,000, and maybe that is the reason it has a capacity of 150,000, even though demand is 180,000. Division A, but Division A has refused to sell Division B any more than current level of adapters applies to it. The manager of Division B is unhappy. He has a special industry contract who he could buy the adapters from at exactly the same price charged by Division A. If he were given the autonomy to purchase from the outside the group. Okay, now see, there's another problem here. Division A has refused to sell Division B any more than the current level of adapters it supplies to it. Okay, so means 150,000 can be sold. I thought it said it doesn't want to make sales anymore. Okay, 150,000 is selling. Now what Division B wants to do is it wants to buy it from external supplier. Now the problem with that is there is a capacity of 150,000 free. If it buys it from the external supplier, what happens is all the profit goes to that external supplier. Now even if Division B is buying at $13, okay, there is spare capacity, it is paying more, but their profit goes to Division A and it stays within the business. So now there is the issue of spare capacity. If there was no spare capacity, then it would be okay. But now, because there is spare capacity, and then still, if Division B buys from the outside, remember, there would be a huge effect on the profit. Okay. After discussion with both of the divisional managers, and to ensure that managers are not demotivated, head office has now agreed to change the purchasing policy to allow Division B to buy externally, provided that it optimizes the profit of the group as a whole. Remember, if the profit of the whole group is maximized, then it would be okay. But remember, when there is spare capacity and you still want to buy from outside, then usually profit would not be maximized. Okay, now coming to the requirement, specifically answering those. Okay, under the current transfer price, prepare a profit statement showing the profit for each of the division and for the portable group as a whole. Your sales and cost figures should be split into external sales and internal divisional transfer where appropriate. Okay, first thing they are asking, current policy, not asking for any recommendation, just calculate the current profit. Next, assuming the new group purchasing policy will ensure optimization of the group profit, calculate and discuss number of adapters which Division B should buy from Division A, and number of adapters which Division A should sell to external markets. Okay, now they are asking for recommendation. C, calculate and discuss what the minimum transfer price per unit would be for any additional adapters supplied above the current level by division A to division B so that division B can meet its maximum annual demand for new portable batteries. Okay, current supply is 150,000, but it has a capacity of 180,000, see above. So the 30,000 more is needed. So they're asking what is the minimum transfer price for that additional adapters. Okay, let's answer this question. Okay, I brought this question to Excel, so it is easier to put it in format. Okay, first requirement was to calculate the profit of each division and group as a whole. So we have division 1A, division B, and then the whole group. I'll write this a little bit separate. Okay, we have sales, external sales. External sales are, for division A, is 200,000, and it is selling at 15. So a good thing to do is to calculate each division's profit individually and then find the group. Otherwise, you will get confused. So I will calculate division A's whole profit, even if it is in external, even if it is internal. Individually, it doesn't matter. As a group, it matters, but not individually. So internal sales are sold at 13, and we are selling 150,000 internally. So total sales collectively is 495,000. And then variable cost for external sales is 3 plus 4 plus $1 additional that is incurred, which is said here. In addition to 3 and 4, $1 additional is incurred, multiplying that by 200,000 sales. Internal sales, only the $3 and $4 is incurred. That $1 additional is not incurred. Adding it together, we have 265,000 variable cost, and there is a fixed cost as well for division A, which is 2.2 million. So we have a profit of sales minus variable cost minus fixed cost of 100,000. Next, look at division B. All of its sales is external sales, which is selling at 180. Capacity is 180,000, but it is only making sales of 150,000. It doesn't have any internal sales, and this about 27 million is the whole sales. 150,000, yeah. This is correct as well. Okay. Next, variable cost. All of it is external sales. We have $13 plus bought from the division, 45 other materials, and 35 the labor. So when we are calculating divisional profit, we consider the internal cost as well. And then multiply that by total number of units, which is 150,000. We have variable cost. Fixed cost was given above as 460,000. So that means we have a profit of sales minus variable cost minus fixed cost, about 590,000. Now as a group, some things will be cancelled. Okay, external sales is okay. We add that, but not external sales. So overall sales will be about 30 million. And then variable cost. Internal would be, I will add all of them. Remember, variable cost is incurred for division A, even if it is selling internally or not. But remember, the $13 that is included in this one will not be incurred. And I've already calculated this here as a sales. So I'm just going to minus that. So it is going to give us variable cost as a group. Fixed cost is okay, no problem here. And we have profit as a group of sales minus variable cost minus fixed cost of 769,000. And if you add these two together, it should give you the same answer. So when we cancel internal things, overall doesn't change, just those specific components will change. So this is what was required. Under the current transfer pricing system, prepare a profit statement showing the profit for each of the division and for the portable garage co as a whole. Your sales cost figure should be split into external and internal division transfer, which we already did. Okay, next requirement. Assuming the new group purchasing policy will ensure the optimization of group profits, calculate and discuss number of adapters which Division B should buy from Division A and number of adapters which Division A should sell to external market. There are 3 marks available for calculation and 3 marks available for discussion. Remember, there is 2 situations here. One, spare capacity, which is 150,000, and another is extra. I'm talking about the need of the Division B. Total Division B needs this 180,000 compressors. Now the spare capacity, if it buys from external supplier at $13, which is the price that the current division is charging, then the profit of the group would reduce. So for this 150,000, Division B should buy from Division A. If Division A could sell this outside, then it would be okay. There would be no problem. So they should buy Division A at 13. Now for this extra 30,000, Division B should buy from external supplier at 13. Why? Because Division A can sell this 30,000, which it currently is doing, included in that 200,000. It is selling it at 15 minus the additional cost that is incurred $1. It means it is selling it at 14. So it is earning $1 extra from the external sales. So remember, I told you whenever there is external sales, usually if there is a cheaper price that the buying division can buy, they should buy it at cheaper price. And if there is a higher price that the selling division can sell, they should sell at higher price. So for 150,000, I will explain it. I don't need to write it, but this is what you will write. For 150,000, as there is spare capacity, Division B should buy from Division A at $13. It will maximize profit because Division A is only incurring the variable cost. If they were bought from the external supplier, then the group profit would be reduced. For the 3,000 additional, Division B should buy from external supplier because they can buy cheaper and A can sell it externally expensive. So good decision would be to buy those 30,000 from external suppliers. Okay, next, calculate and discuss what the minimum transfer price per unit would be for any additional adapter supplied above the current level by Division A to Division B, so that Division B can meet its maximum annual demand for the new portable batteries. Okay, even though they asked for the additional, but I will explain both. They said minimum price. Remember, minimum price is not fair price, but it gives us that lower limit. They didn't ask for the 150,000. For 150,000 minimum price, would be $3 plus $4. This is the minimum price that would be charged. But obviously, this is not a fair price. Minimum price doesn't mean fair price. For 30,000, it should charge what it is charging external supplier. The contribution foregone, which would be sales minus the variable cost. But easiest thing to do is whatever you are charging external supplier minus the saving that you are making from internal sales. So the minimum price for 150,000 would be 7, and the minimum price for 30,000 would be 14. And you have to explain why. For 150,000, because there is spare capacity, division A is only incurring the variable cost. There is no additional cost incurred, so 7 would be the minimum price. For 30,000, because it can sell it to the outside, and it can sell it at 15, and because it is making sales internally, $1 would be saved, so it should sell internally at 14. So with this, our F5 is complete. So consider it complete. I will do, in due course, I will do some questions from the kit as well. Maybe 1 or 2 videos every week. Otherwise, this is it for F5.